Hello, folks. Bill and Brian here with our Wednesday update on the energy markets. Brian, let's roll that logo. Let's ride that roller coaster that's called crude oil. And for my goodness, what is we doing with nat gas? It's all going crazy. Hey, let's just
This
throw
was a
it.
conspiracy that had to get all those people to lie.
That's right. I can't believe it. So let's just throw in a war to make it interesting.
Yeah.
So,
Yeah.
Brian, what do you want to talk about today?
Well, we're going to talk on crude oil mainly. We are going to touch on natural gas. And which should we do first? Because I think we're going to spend a little bit more time talking about crude oil.
Tell you what, let's start with natural gas, and
Okay.
we'll go from there because it's moving up. It's above 3. It's sort of in a little zone right now, but I think it's going to be a little bit different going forward.
Now, originally, when we scheduled this, we thought we're only going to talk about crude oil, but with what has happened over natural gas, we could not ignore what has happened. Now, our members for Rogue Edge, our members already know this. We have been firm that $3 is coming, and likely when we get there, we're going to say goodbye to $2 for a very, very long time. And there's a lot of fundamental reasons why. We're not going to talk about that too much this week. We are going to touch on it next week in our live cast on weather. We're going to talk about U.S. weather. We're going to talk about European weather, what's in store for the winter, and the remainder of injection season, which is roughly the month of October. So we do have storage.
Maybe their final winter forecast, right? Because after that, it's actually is winter.
Yep. And we did also publish our year-end forecast. If you want to find out a little bit about that, you can learn more down below. Book a meeting with us, and we are going to have a Rogue Edge commercial a little bit later in the session, but we're going to save that for a little bit later. But a week ago, we were 296. And now we're at 330. So, I mean, that's a massive move. That's a 10% move. Now, a lot of this was driven on storage. So let's take a look at what happened on storage. And we go here. And if you take a look, this keys in on what we've been discussing over the last couple of weeks, that we haven't seen a triple-digit injection. And that is very atypical for September, October, and a lot of this is driven on demand consumption being higher than expected. Production declines are coming. We're not going to talk too much about that, but with an 86 injection, I think the average consensus was around 93. So that's a 7 BCF. Now you got to bear in mind, folks, that guesstimating storage has about, from all the analysts that study this day in, day out, they pour over numbers. They're still off by 2 BCF a day, or 2% of the market. That means they're either overestimating production or underestimating demand if storage injection came in lower. So this is playing into where we thought, and part of the reason that we've been discussing the fact that this move is coming, and that when it comes, it is going to stay. So,
and they've been off for like 3 weeks solid at that same level.
Yep.
If not more.
Well, and when I look at it, when I combine this with our weather, which again, next week, we're going to talk pretty heavy on natural gas and more on weather. We just wanted to touch on natural gas on the front side of this section because it is important, especially given what has happened here. And especially given that with what has happened in Israel, there is still a lot of LNG that comes into Europe, and any volatility here disrupts ship traffic. We're going to talk a little bit about ship traffic a little bit later, but there's a lot of reasons why natural gas is up. If you want to learn a little bit more, you can book a meeting with us, drop us an email, or join Rogue Edge, which we deliver weekly videos like this with deep insights to our community. But we'll save the commercial for a little bit later. Any comments on gas before I close that off?
I just think that it's going to be a lot stronger than what we're thinking right now. Even with our end of year projection, I think we might even be bearish, which would really be a change.
You mean on price?
Yeah.
Yeah. So this is the reason that we've been bullish is we see this production number dropping, and I've seen conflicting reports that we've bounced up over 101, but then back down to 100. My year of end production target is probably 98, which is a little aggressive. However, if we cross this 100 threshold, all the traders that are bearish are going to flip, and I think this is the trend, and the reason that we're starting to see this jump up so much is because they're seeing increased demand and they're seeing decreased supply and storage underperforming. Because when we started the injection season, let me go back to the storage chart. When we started the injection season or a closed off winter, we were at 5-year max.
Right.
And we've come to within 5%, roughly 5 to 6% of the 5-year average. And we started close to 20. So we've had quite a move on gas. But
we'll talk more about that next week, folks. Or just book a meeting with us. We'll be happy to go over the numbers with you. Let's talk about some crude oil, because this is the one that's been sort of like
so
roll the dice. Baby needs a new pair of shoes. Let's go.
So once we, let's see, at the end of September is the last time that we touched 95, and we dropped all the way back down to the low 80s. We didn't get, let's see, 81.50 was
your
the
support
low
line
there.
right there, wasn't it? Yeah.
Yep. And that was right at the support line. That's kind of what we expected. When Israel happened, we actually communicated with our when the Gaza Strip, Hamas, and when Hamas attacked Israel, we knew that there was going to be a price reaction. Actually, this is a lot more muted than I expected. I expected us to go up to 89.14. Fundamentally, I think we should be up at that level, but we'll cover a little bit about that. But let's talk a little bit about some headlines. Oil prices that fall again. Of course, this was after today's move, and we're trading lower for the second day as investors are gauging that supply threat. And the reason it's a supply threat is when you look at crude oil. So the U.S. produces roughly, let's see, right here, 12.9 million barrels a day. Okay, so the U.S. that's last week's report. Next week's report is going to be coming out tomorrow, or this week's report is going to be coming out tomorrow. 12.9 million barrels a day. Our world demand is hovering around 100. Fortunately, that makes it easy to do math. So around 13%.
Exactly.
Yeah, kind of lucky there. So around 13% of the U.S. Is supplying 13% of the world oil demand. What is fascinating here, and the reason that Israel is super important, is because of ship traffic. When you take a look at 100 million barrels a day of crude oil, 35 million is transported by ship, 19 of which is transported by OPEC nations, which happen to reside all around, in and around this area. So the Suez Canal is super important. Yemen is super important. So all of these are super important. And if something disrupts here, that's the reason that oil is a problem, because this creates a potential challenge for some of the ships through the Suez Canal. So let me pause there before we go anywhere else.
So why did you pause?
Well, no, I was pausing there to see if you wanted to say anything. And hey,
Well,
James, good to hear from you. So, for those of you that don't know, Arcus FX, they have technical signals. James is active on our channel. Thanks, James, for showing up. We're talking a little bit about fundamentals. Hopefully, you caught the natural gas section. We talked a little bit about that. If you want to touch base on that, just let us know. But we're talking a little bit about crude oil and how much goes through the Suez Canal.
right,
And it's not 19 million barrels a day, but it's a lot of it. So
right. So
there's
it's
a
hard.
lot.
So it's the thing is anything that's on a ship has a lot of volatility you can have around it. In fact, is when a ship leaves one port, it trades the oil on that ship trades multiple times before it ever gets to its destination. A lot of times they'll leave port and not know exactly where they're heading because they don't know who's bought it yet. So there's a lot of activity around waterborne crude oil, and so the price can go up, can go down based on where, and it may move to a different port based on the price it can get. I think the thing to watch here is not only is that area very volatile on its own, we are now seeing things happen that have nothing to do with fundamentals or technicals. It's geopolitical.
Right.
And we've talked about this once or twice before. The one thing you can say about geopolitical is that if anything happens, it has a tendency to increase the price of crude oil.
Right.
You know,
well, because supply disruption. Now,
right.
I will say one of the interesting things, and here's what we want to talk about today. 1/3 of crude demand is met by ships. Okay. 35 million barrels a day. Most of that is shipped by OPEC states, which, as we touched on,
Right.
is going to be in and around this area. Some of that is going to be impacted by the Suez Canal, which the Israel conflict is there. But you may have heard about disruptions in Yemen, and I mean, both sides of this are super important because Saudi Arabia ships up and down, and that's where 2 million barrels a day, and 2 million barrels a day makes a big difference. In other words,
It'll
Saudi
move the
Arabia
market.
well, Saudi Arabia cut 1 million barrel a day, and we went up by $5. So the thing is that 2 million barrels a day is a very big disruption. It sounds like, wow, 2%. 2%, things start breaking down in economies and whatnot. But with that being the case,
You know, it wasn't
you,
long ago, Brian, that there was actually a ship that blocked the Suez Canal. I don't know if you remember that or not.
oh yeah, I do.
Okay. But it didn't just stop the crude oil. It stopped the all trade going through there. So
Yep. And no, and well, and that's why this could be big. Now, James, great point here, and thanks again for showing up and chiming in. And the reason that we went from 95 all the way down to 81 is exactly what you're articulating. And one of the demand concerns is the reason we went from 95 to 81, and those concerns are real. There
and
are a
James,
lot of economic numbers that support that.
James, Brian, and I were talking about earlier before we got on air how it is so easy for prices to go down. Actually, if nothing happens, they will always go down. And so that is why when we see this stuff going on, that's where the bullish comes. But there comes a point to where a lot of people don't realize that in 2023, demand for oil grew by 2%.
Well, OPEC's numbers. Okay, So when you're talking about oil demand, and oil demand gets, it sounds simple to spout out a number on oil demand, but it gets very tricky because a lot of people are back ending what that means on crude oil because they're really talking about demand on gasoline, diesel, distillates, like all the products that are created at refineries. So it's not you're not burning crude oil in cars and whatnot, but the demand factors, there's a lot of different opinions on what that demand number is. Saudi Arabia came out and said, I think a couple weeks ago, that they thought we were 3 million barrels a day undersupplied. I think the International Energy Association was looking at 2 million barrels a day undersupplied. EIA was 300,000 barrels a day
So,
undersupplied.
Brian, I'm going to have to look at this. To me, that doesn't ring true. Here's what rings true: the world has X amount of refining capacity. Like you said, you don't burn just crude oil.
Mm-hmm.
It has to be refined.
Right.
And I believe the refining capacity of the world right now is only about 103 to 105 million barrels a day.
And they don't run at 100%, right?
Well, they usually don't. That's correct. We're about to up that by 1% this year with a couple new refineries, one in Mexico, one in Nigeria.
Mm-hmm.
So when I talk about demand, it's actually into the refineries, because whatever goes out the backside is going to fluctuate based on the product price. That's why we saw 6 million barrels of unleaded gasoline go into inventories, but they had to produce because they need the diesel. The world runs on diesel.
Yep.
And so, but you can't separate those in the refinery as far as, oh, I only want to produce diesel today. You have to produce the unleaded with the diesel. So when I think about refinery, I think about world refinery capacity and how much of that is utilized. And so I really think that we've gone up by 2 million barrels a day. We have the capacity to go up by another 1% next year. But after that, we run out of refining capacity. So I'm going to check my refinery numbers to make sure that I'm right on there.
Okay.
But that's when I talk about demand. I'm not talking about demand for diesel. I'm talking about how much is going through the refineries.
Yeah.
But
And that's
it doesn't, it doesn't matter on the other side as far as, I mean, if you don't have the crude oil, you don't have the diesel. If you have the crude oil, you have the diesel. And it's
using that lens, and it gets rather dicey. Let's take the U.S. For example. The U.S. refining capacity is we're currently running 15 million barrels a day through, but our demand is actually much higher. We are actually importing more crude oil and exporting. We're net exporting about 1.3 million, or net importing 1.3 million barrels a day. That's a lot less than 10 years ago because we could not export crude oil.
right.
And
It's actually literally against the law.
And for those of you that may not understand why we import and export, it's because of crude quality. So we import heavier crude, sour crude, and there's a lot of good products in there. And we export lighter end crude because there's a little bit less that can be made on the refined product side.
Well, our refineries are not set up for them.
But we also export a lot of refined products, don't we, Bill?
We do export. We actually export a lot of diesel.
Yep.
And import a lot of unleaded gasoline.
Yep. So let's take a look at, let's work backwards.
And also let's remember that when you look at petroleum, when they call crude oil, they're also included NGLs and condensate.
Right. When we look at the OPEC numbers right here, and we look at this does include OPEC liquids production. So that's included in there. But let me take a moment. I'm going to take a couple minutes. Bill, you're going to start a clock for 3 minutes, right?
Sure, gotcha.
Okay. So listen, thank you for tuning in. Really appreciate having you here. I'm going to take 3 minutes and just talk about our platform, energyrogue.com. Come visit it. It costs $89 a month. And for that, what you're going to get is you're going to get access to our world-class platform for supply, demand, imports, exports, pricing for natural gas, NGLs, crude oil, refined products, electricity. It also has asset maps, and you get access to a world-class platform that has over 150 charts that help you understand the energy markets. In addition to that, we also send out a weekly PDF at the beginning of the week, and we talked about particular price levels that have come into play this week. You know that watch 84.50 as an indicator for a gap close at 83.28. That happened today. Yes, you can. I'm gonna finish this though, but that's not all. You're also gonna get access to a video like this that we cover in depth on the energy markets once a week. Plus, we have a very active Discord community where we're covering different price expectations and communicating on the markets. And in addition to that, we provide a little bit about subjective viewpoints. So, did I make the 3 minutes?
You made the 3 minutes.
Okay, so let's get back to reality. So James has another good question. 5 to 6% of total oil is produced to propel ships. That's actually great. I did not know that. So hey, James, thanks so much. Thanks for stopping in. If you're heading out, that's
But
huge.
James, a lot of that's moving over to NGLs. So we'd have to, if they're using the NGLs out of the total crude production, that might be what you're seeing there.
Well,
So
let's take a quick look at that though. On the OPEC NGLs only, let me click on and off that. This is just the OPEC NGLs. Our condensate here is quite a bit. I mean, we have, so OPEC alone has about 5 million barrels a day of what's called liquids production. So
right.
I'm wondering, we got to do some more work on that. That is actually great insight. Thank you, James. Really appreciate that comment. So when we're taking a look at where we go from here, right?
Right.
We've covered a lot of things. We've covered the fact that 35% roughly of the global oil market is on ships, right? 35 million barrels a day. And now, thanks to James, we understand that 5 to 6 million barrels a day of that is consumed in those ships to get it from point A, point B. The Israel conflict holds the Suez Canal in a very tricky light. And that is the reason that we went up to this 85 and kind of stalled out. We did a gap close down here, and it really gets back to something that James was talking about. That is, what is the demand forecast? And there's different demand forecasts to where OPEC is calling for how many barrel a day increase. Bear in mind, we're all moving to Teslas in advanced economies, but how much did crude oil demand increase supposedly from Saudi?
They're saying about 2%, and that next
That was
year
Saudi Arabia, right? 2%?
Yeah, and it's going to be about another 1% next year.
About a 1% next year. Okay.
So the bottom line is the demand is not necessarily going down. If we're looking at our supply going down,
so that means 2 million barrels a day.
Yeah.
So another 1% is going to be just over 1 million barrels a day. Now, I do want to talk about, a lot of people have gotten complacent on the supply side of the equation because they have seen this curve, which is we have grown our crude oil all the way up until COVID, then we dropped and have since recovered and gotten back to the highs, close to the highs, not quite, of 2020, right before everything went on whack.
But you see that chart going up. So that started back in 20, what was that? 20, where were we? 2014, I think. This is when we have got the right to export crude.
Right. Yep. Yep.
And so
that timeline maps out, right?
right.
Because if you look at that, but I mean, the reason, if you take it all the way back, I think this data set starts in the early 90s. We just dwindled, and then around here was the shale revolution, and we figured out, oh wow, we can really be good at that, and that's where we ended up. Now, what we're looking at is with this rig drop right here, okay? We're seeing rigs drop off on the weekly. When we look at this, I mean, we've gone from let's see. Oh, I'm on crude oil. Yeah. Our base decline in the United States on 12.9 million barrels a day is over 600,000 barrels a day every month. So every month, if we bring on 0 new wells, we lose 600,000 barrels a day. So that takes us from 12.9 to 12.3, 12.3 to 11.7. The path gets very dicey. And what we've been tracking, and part of the reason that we have this platform and have it for only $89 a month, this is what the institutions look at. This is what the big banks, access to all of this is critical, and taking the data and looking at it. But what we've been watching is new production has been dropping ever since 2022, and we're now down below that 600,000 barrels a day. And what you can see over the last 2 months, September numbers are not quite out yet, but this is the curve that we've been looking at, which is declines plus new production. Are we gaining or losing? And as you can see, yes, we were gaining in 2022, and we were still gaining in 2023, but we've now hit a decline, and we're going to start to see that decline happen. So as the global demand hits recession, some of that is going to be consumed. I mean, if we lose 2 million barrels a day, I would argue that in 6 months, if price doesn't respond, if we don't see 100 plus, that we're likely going to see a million barrels a day of that be consumed in the declines. Well, not declines, the loss of production here in the United States. What do you think of that, Bill?
Yeah, when we talk about declines, we always have to be careful because all wells decline. But what we've done is we got into a net decline now, and that in itself is strictly all about capital investment.
Yep. Well, and the main thing is that you can see it right here on weekly oil rigs. There's a lack of investment. Ever since 2022, we have continued to drop rigs. Now, there is an argument for longer laterals, and yes, there is an efficiency gain, but this is what we're looking at. Declines. We're facing declines, and new production being added is less every month. And I think September numbers are going to be out in 5 days. So we'll be able to take a look at that. And we can take a look at particular basins. I mean, let's just take a look. Everybody loves talking about the Permian when they're talking crude oil, right? Look at that. They've declined from bringing on 375,000 barrels a day of new barrels a day in April to 348. So, I mean, they're dropping 50,000 barrels a day, and you can see this is let's take a look at what the Permian declines are. And let's see, we got, yeah. So Permian is in decline right now. 376 and we're at 348. So,
So
hey,
I think
Giorgio, how are you? Good to see you. So
I
thanks for
think
stopping in. If you got any questions, folks, you can, I think on LinkedIn and YouTube, you can drop a comment, drop a question. We should see it and respond to it. But what were you going to say, Bill?
I said the more oil that we have found in the past, all we've done is actually increase the amount of decline we have.
Yep.
And so a lot of people don't realize that you can't. It's a math problem that starts going on that pretty soon we have more and more decline, then we need more and more production to keep the net up.
So what we have, and this takes Wolf Camp, which for those of you that are not familiar, Wolf Camp is in Lee County, New Mexico, and that is one of the more prolific zones. Wolf Camp is a zone of depth in the Permian Basin, and that zone of depth, when they bring on a new well, and this is what Bill has talked about, when they bring on a new well, the first month it produces 1,300 barrels a day, almost 1,400. Let's call it 1,400. By month 12, we're at 217. Okay. So the thing is that when a new well comes on, it is going to decline, which means we have to continue to drill and bring on new wells. Otherwise, we will decline. That's part of the reason that when we take a look at supply, we take a look at declines and what new production is doing. And if you want insight to this, I mean, this is what the institutions look at. Sign up with Rogue Edge, join our community. We talk about this on Discord all the time. And the fact is, we don't have enough investment, and that's reflected right here in the oil rigs. And we are going to face declines on oil. We are going to face declines on natural gas. Now, to what scale is a different question, and we'll cover that in a different session.
And the other thing is, it takes longer to ramp up. You can't just. It's not a switch you flitch. You know, you've got to take the time to. I mean, by the time you get permits, by the time you get different permits for different things, it'll take you 6 months to be able to get a well permitted.
Right.
So it's not like you can go out there and say, oh, we'll drill this one, this one, this one, this one, this one. And so that's why it's hard to get the commitment for capital, because they see the price going up and down. It's very volatile. So I would say this, that if this conflict spreads currently in the Middle East by any measure at all, you're going to see this oil price get extremely volatile. And so I think that's the thing that I'm watching for, and I think Brian's watching for, is that if it starts to spread outside of the confines that it is now, I mean, it's already dangerous. It's already tragic. But if it begins to spread further, let's just say it's not going to be good.
So on that, let's talk a little bit about a lens into the future, and then we'll kind of close it off. Feel free, folks, to ask any questions down in the comments, and I think we should see them live. If not, we're going to comment back to you. So the pathways forward. I'm going to list off a few things, and this is going to be the path forward and considerations. James brought up one of them. There's concern around economies and demand. Okay. One of the other factors to consider is 35 million barrels a day, or 35% of the global market on crude oil is transported by ship. That is going to, and 19 of that by OPEC members. And most of the OPEC members, 19 million barrels a day, or roughly 20% of the market, is transported by ship, and that the shipping paths with conflicts like this are open for disruption. And when you talk about a supply disruption, Saudi Arabia moved crude oil price by $5 by restricting their exports by 1 million barrels a day. Okay. When we're talking about 19 million barrels a day of different shipping paths, what that looks like, this is going to get very dicey, but geopolitics and US elections are going to come in heavy. Russia, Ukraine, that's a factor. That's unstable. Don't know what that's going to look like this winter. A lot of people didn't expect us to be here a year. Last year, we didn't expect to be here right now. Iran has been negotiating with the US. Now I don't know where that stands because there's rumors that Iran was potentially involved in Hamas attacking Israel. Who knows? We're not financial advisors. We are not geopolitics. We're only reporting what is being reported out there. Saudi Arabia has their own interests in moving some of the barrels that they sell off the dollar. That has an impact to crude oil price on WTI. WTI is now included in the Brent index. So now we have a different relationship between WTI and Brent. And the last two variables, China, don't know what is happening over there. There's a lot of concern about demand. I'm not concerned about that. I'm concerned about what they have sat on the sidelines, and I'm not sure where they will align, if they're going to stay on the sidelines. But the last thing is U.S. elections. We are coming into a time that I hate turning on the TV because it's just going to annoy me, all the political ads, and I do not like the political rhetoric.
Now,
But
Brian,
that's my 2 cents.
the favorite son of Oklahoma, Will Rogers, once said that we shouldn't be worried about politicians because our country has the best politicians money can buy.
Oh yeah.
So I think what we're looking at here is that the fundamentals are always the base where we always go, and fundamentals are looking bullish. Bearish is our interpretations of other people's economies, which goes back and forth. And so what people do is they read what they're doing and make an interpretation of what that is. A lot of people say, well, China's not buying a bunch of crude oil right now. Well, they didn't buy it at $90, but they bought a bunch of it to fill the strategic petroleum reserve at 60 from Russia when everybody was banning them. And so they could be coasting on what they've got on their inventory. It is a tough game on geopolitics, both in the economic side and in the military side. So I think that right now we're staged for oil to move back up. I think gas is on its way just based on the fundamentals in the U.S. But realize that even if it's strong, there's going to be some volatility that hits that looks a lot like that chart does for the last 2 weeks.
Yep. And I think it's key because, again, what James mentioned is very much in lens. And that's probably the reason I was surprised that we didn't get up to $89 with what happened in Israel and Hamas. The fact that we stalled at 85 indicates that there's still a lot of hangover on economies and whatnot.
So I would equate where we are right now with Israel and Hamas to the first few weeks in Ukraine.
Okay, I think Bill froze up. So what we're gonna close off with is kind of some price expectations, and I'm gonna talk a little bit about crude oil and the fact that we've stalled out in this mid 80s range. We did drop down today and came back up. And if I'm projecting into next week, let's take a quick look. And Giorgio, I'm going to get to your question in just a second. But when I take a look at where we potentially should go, fundamentally, I see 85 as a solid floor. The fact we're trading underneath that, I think, is reflective of what James mentioned, James at Arcus FX. And if you're curious and serious about trading the financial side of the markets, he's definitely your guy. But I see this 85.94 as kind of a key battleground. And this is where I see us potentially pointing up to 89.14. My year-end target is still 95. I'm staying uh, convicted to that. I don't know how it's going to get there. We could go down before up. I think fundamentals are still strong, even though we have demand concerns. I think they're very valid and very stable at $85. So that's what I'm seeing on the crude oil side. I just shared, Bill, my expectations on crude oil price, which I'm sticking to my year-end target of 95, and that 85, 95, $86 is going to be a battleground. What's your expectations? Are you there? Are you with us?
I'm back with us. They
Okay.
apparently they were listening to me and they shut me off.
Yes, apparently.
So when we're talking about crude oil, the expectations, where did you said you came back after your 98? Where were you,
My
98 or
year end,
95?
I'm sticking with 95. We're not financial advisors and we do not, I have stated a Holiday Inn Express, but I'm sticking with my 95 year end exit.
I'm still at 99.27. In fact, I think I could end up being bearish there.
Okay. So, but I do see short term, I see a return to 89.14. I don't see too much downside from here. I see upside from here. So that's my 2 cents on crude oil. And let's finish up with natural gas because Giorgio has a great question. Do we expect short-term price cooling and then a spike upwards come December? And Giorgio, that's a great question. Be sure to tune in next week because we are going to talk about weather and we are going to talk about demand, end of season storage, and what we see for the winter. But if we are genuine about weather and expectations, we expect kind of October is going to be a month of two halves. The front half is going to be cooling degree heavy. The latter half is going to be heating degree not heavy, but heavier than normal. And so I think we are just getting started on our price. We are gonna today's price action is a healthy correction and seeing the volume go back up as we're headed back up to 344. I think we're going to see an extension up, and I think there's a spike coming, but we may, my opinion, I think we've said goodbye to $2. I don't think we'll see a $2 handle for a very long time. So that's my 2 cents. Bill, are you frozen? And if Bill is not frozen, I'm going to speak. My year-end expectation is $4.10. That I revised that up last week, I believe. And I will be sure and tune in next week, and we'll talk a little bit about that year-end expectations there. But the levels that I will watch, Giorgio, just to get back to your question, 344.9 is the levels that I'm watching, and 324.7. The fact that we didn't break below 324.7, I think this is going to be whittled away, and we're probably going to extend back to this 367.68. I think we're going to be in the high $3 range. And we may not be waiting till December for that. But Giorgio, if you want to learn a little bit more, we do talk about this in our Discord channel daily. We talk about price expectations and gap fills and all that kind of stuff. We also have fun, patience, grasshopper, and we talk about storage expectations every single day and what those expectations look like. So our Discord channel is very, very active. And let's see, I think Bill might be joining. So we're kind of closing off. Bill, I gave my price expectations that I think we've said goodbye to $2 handle and that
Okay.
324, 344 is going to be the next battleground, and that I see high 360, 370 as our next stop. But my year-end target is 410. How about yours? And we're not financial advisors.
I'm still below $4 on the year end. I'm still at $3.99. I'm staying below $4.
Okay.
Giorgio, I keep saying that wrong. It's Giorgio, right?
And Giorgio, make fun of us if we're not pronouncing it correctly. Make fun of us, mock us, do whatever.
What happens is that as we start winter, everybody is sort of muted because they don't know what the winter's going to be. If December's really cold, you start seeing the prices come back, and then you start seeing it around January when you start seeing if there's a shortage if we've used a lot of storage and winter's still cold and are producing real cold, you'll see that price spark right back up.
Okay. So I think, unless we have any questions, and okay, it sounds like perfecto. Okay, we're saying it. We're saying it right. Giorgio, thanks so much. Really appreciate you stopping in. And James, it was always great to see you. And Vampire Slayer, wanted to get back to your question. You asked this even before we went live. Natural gas will easily blast through $4, and I think $5 may be in the picture before December. I think you might be right here. So anyway, be sure, if you learned anything, if you appreciated this, please please comment, please share it. Every comment, every like helps us grow this channel, because we're trying to grow, and we appreciate you being on this journey with us. And we're just excited to be here. So I don't have any more. Do you have any more, Bill?
Yes, book a meeting. And you know what? I may have been talking about the lizard people in the moon too much. They may be affecting my internet.
And we want to give a big shout out to the Y-Files. We love that show, and the lizard people in the moon will make sense if you watch some of that. It's just a whole lot of fun. So listen,
appreciate you guys.
Appreciate you. Drop us a line if you have any questions. We're here for you, and really appreciate that. And let's see. You know what? That is actually true. Statistically, December during the month typically does go down. So that's a great one. And thank you for commenting on that. So
there's a lot of traders who believe in that, and they'll sell first of the month in December instead of gas daily.
It can be a risky move. You may have a 20-cent move down, but you may may be holding percentage-wise. So think about it this way. I want to go back to this because I want to close this off. We're not financial advisors, but I've traded commodities for over 20 years. So what you have to watch for in December is you may have a 85% probability that natural gas will erode down by 20 cents, maybe 30 cents, but you're holding a 15% dollar move to the upside. So the thing is that percentage-wise, it will move consistently down more often than not. But what you're doing, it's kind of like option math. What you're doing is that you're playing the risks the other way. And Vernon, appreciate you stopping in. I know you're here all the time, so I appreciate that. And listen, I just appreciate y'all. Thank you for being on this journey with us. And if you
like
need
and
anything, subscribe, drop us an email, and that's
better
all
than
I got.
that.
I want to close
sign up.
out. Yeah.
So, folks, we appreciate it. And Brian, are you ready to roll that logo?
Yep, roll a logo. Come join us, and it's a movement. So have a great one. Plus, if you sign up, you even get a t-shirt. You do have to email me for the t-shirt if you sign up. So sign up today and you'll get a free t-shirt. So that's all I got.
See you guys.